Guys, a recession is pretty much around the corner. So how do we invest into this thing? How do we survive it? And what tactics can we use to better ourselves for the future? In this video, I'm going to cover just that. An article just came out today and it says, Citi warns rolling recessions will shake global economy in 2023. The global economic outlook for 2023 is murky at best, economists at Citi warn. As we survey the prospects for the global economy, we see many reasons for concern, including continued challenges from the pandemic and the Russia-Ukraine war, high inflation, and headwinds from central bank rate hikes. Citi chief economist Nathan Sheets wrote in a client note Wednesday. Reflecting these factors, the global economy is likely to endure rolling country-level recessions during the coming year. When I see an article or read an article like this, the immediate thing that I think in my mind and my mindset is essentially programmed to say, okay, this is an article of fear. There's either two kinds of articles that exist in the stock market world as far as I'm concerned. An article of fear and an article of euphoria. Now, when an article of fear gets introduced or shown, to me, I get excited because the common person is going to essentially say, oh God, interest rates up, inflation's up, all these things are up that decrease my spending power and my investments are going to get shot. Everything is going to start going down and the economy is going to go down and stock prices are going to go down. And all they see is that little ticker symbol starting to decline over the course of the next coming months. And they're going to be more likely to sell and follow the herd. Here's the fact about most investors. They like to follow the herd. When people are buying, they're buying. When people are selling, they're going to be selling. I like to look at it like this. And it goes back to this old saying, you've heard it time and time again. Be fearful when others are greedy and be greedy when others are fearful. One should definitely be stockpiling cash. It should be the number one first step. You stockpile cash because then that's going to be able to cushion you going forward into a recession. Time's going to be tougher. There is going to be things where we have to obviously buy, like staples, like food and stuff like that. I'm going to anticipate the market decreasing. I'm going to anticipate stock prices going down. With that cash that I'm stockpiling, I can now get companies that I actually have a position in at a lower price. That's what I'm looking at. I'm looking like 3 steps ahead. Here's the thing, folks. If you are investing for the long term, I mean the actual long term, like you're thinking 10 years down the line, you have to leave that cash in there. You have to leave it in there. Because here's the thing, folks. Recessions don't last forever. You go back in history and you look at the Depression, the 87 crash, you look at the dot-com bubble, the 08 recession, the COVID March 2020, stock prices do fall. But eventually they return and end up being higher than they were before. Look at COVID, the most recent crash. In March 2020, everything dropped by like 50%. And then stock prices just within a year jumped back up in pretty much a V-shaped recovery, now hit new highs. Granted, that wasn't a recession, but even you circle back to 08, the 08 recession, as stock prices dropped in 08, pretty much 010, things were starting to look up. Things were starting to climb back up again. They don't last forever. And ideally, if you're doing the right research, folks, and if you're following this channel and actually how to find good companies to take a look at and hold on for the long term, and what I mean by doing like a 10-year analysis, literally, do you believe this company is going to be around for longer than 10 years? And if you think, yes, that company that I'm taking a look at is going to be around for longer than 10 years, and factor in recessions. Let's say this recession lasts 5 years. Okay, that's 5 years of garbage numbers for this company. Okay, but what does that mean? That means that the other 5 years are going to be phenomenal. So let's say the stock price tanks for 5 years. You should be happy about that because you know that business is going to survive for another 5, right? You are able to now get this stock price at a lower price point. And I'm going to give you an example. Now, Meta is a company that I've analyzed a lot on my channel. You can find analysis here of a deeper dive. Take a look at this, guys. As soon as it went public, this is just after the 08 recessions in 2013, it went public and it started climbing up. Now, 2019, it goes down a little bit. In 2020, that's the crash, right? COVID. And look, it just starts climbing once again. And now, from February 2022, this stock price has been decreasing time and time again. Now, do I think that Meta is going to get wiped out in this upcoming recession? Absolutely not. They have the largest piece of the pie when it comes to the social media space. That's one of the things that makes Meta great. If this stock price is going to go down and down and down, doesn't mean the actual value and fundamentals of the business is actually decreasing. It's just what people perceive the value to be. And that's the thing where people get confused. People tie the stock price to the actual value of the company. Yes, on paper, if a stock price is more, the company is actually technically worth more, but it doesn't mean what the company's bringing in from a cash flow perspective, earnings perspective, is worth it. Does that make sense? If that doesn't make sense to you, watch my other videos and I will explain to you the difference between what the stock price really means and what the company is actually valued at. And ultimately, when you're looking for companies, you have to find companies that have low debt. Just like in your normal day-to-day life, if you're entering this recession where everything's tight, cash is tight, your job is maybe not giving you as many hours, or let's say you get let go because now they're doing cuts, your debt levels are going to have a huge impact on your quality of life. Likewise, that same principle exists with these companies. So if you are investing into companies that have high debt levels and people are not buying their product as much, meaning they're not making as much revenue to cover their basis, they are going to have problems. I like Meta because they have low debt levels. So now that circles back to your fundamental research. That's just one little aspect, maybe something for you to revisit in case you've missed that. But ultimately, it comes down to what I said earlier. Do you believe this company is going to be around for more than 10 years? If that is the case, do not touch your investments. Circle back to them when the stock price drops even further and double down. That's personally what I would do, and that's what I'm going to do, and I'm waiting for things to decrease. I'm buying Meta dollar cost averaging as the stock price goes lower and lower and lower and lower. Why? Because I think there's way more than 10 years down the line for this company. And I'm dollar cost averaging down on companies that I feel like they're already below their value. And then once things get really, really bad, all that cash that I've stockpiled, and this is cash that I can afford to let sit in my accounts for the next 10 to 20 years without even thinking about it, I'm going to just deploy it. I'm going to say, those are my soldiers. I'm going to say, go take all those undervalued companies, whether that's just investing into the S&P 500 index fund or individual companies like Meta or Apple or whatever companies I feel like are worth a buy. To clean up this video, what are we doing? If you truly believe that the companies you are currently invested in are going to be worth more than they are 10 years from now, they're going to be alive and well 10 years from now, and their stock price is at this point and decreases to this point, you should be happy about that. If you don't feel happy about that, you're in that company for the wrong reasons, and that's something you should ultimately evaluate on. So if you want to learn how to do that, definitely follow my channel. Definitely hit that subscribe button because I'll teach you how to do that. But ultimately, it comes down to that. It comes down to what you truly believe in. If you truly believe in the business, and to offset that panic of that stock price going down, stockpiling cash is great because that's going to give you a buffer zone to either use that cash towards your investments or towards your day-to-day expenses, which is more important depending on your scenario. So ultimately, folks, stockpile cash, double down on your current investments, and if need be, if you want to open up your investments to any other staples like gas or consumer staples like food, that works too. But personally, I think the positions that I currently have available are the ones I want to double down in and see for the foreseeable future as my retirement. Anyways, folks, that is the video. If you found it helpful, and if you haven't done so already, hit the like button and subscribe button. I will see you in the next one. Thank you so much for watching.